Hello everyone, Crypto8 here. So making another video on the MTF Wave Stochastic RSI Indicator. I thought about making a general video explaining how the different curves actually work and how this indicator in general works, because I feel like I've been talking about patterns and how to use it, but I keep seeing comments from people which imply that people are still a bit confused about what this actually is. So I'm gonna go to the basics a bit. So if you do understand it, this is like a revision or so. If you don't understand it, I believe this is gonna be a bit helpful for you. So in order to understand the MTF Wave Stochastic RSI Indicator, you need to first understand the normal stochastic RSI indicator. So the normal stochastic RSI indicator, let me just load it. This is the normal stochastic RSI indicator, and if you look at the normal stochastic RSI indicator, let us just remove all these drawings and start at a larger time frame. What you see what you see from the normal stochastic RSI indicator is you see simply waves. Without any kind of knowledge, they might appear very confusing, but generally they're just waves. Okay, like when you look here, we are making a wave up and then a wave down. Okay, and then this is like a cyclic indicator. It looks a bit like a sine wave, but more unorganized or non-geometrical, I mean. But at the end it just keeps going up, down, up and down, up and down. Sometimes it reverses in the middle, but not so often, and then generally it just goes up and down. The normal stochastic RSI indicator has not much use actually, because it's as much as it's helpful, it's very it can cause a lot of confusion. The reason for that, if you want to understand it, generally this is like an RSI but much more sensitive, because it works faster than the normal stochastic RSI, and it's more sensitive. So if you look at it and look at the normal RSI with it, let's just remove these. What you would see is you have here the normal RSI being overbought, and then the stochastic being overbought as well. But at the same time, when the RSI is being less overbought, like here, or even like here, so for example here, or even here, it gives the same amount of being, or the same strength of being overbought like when it's overbought here. While in the normal RSI, you see that here it was much more overbought than here, and here it was diverging. But the normal stochastic doesn't show these divergences because it doesn't stretch back in history like the normal RSI. So it's generally just a more sensitive RSI. It's very sensitive. Sometimes you see very small bounces in the normal RSI that show as being overbought or oversold, so it's much more sensitive. When you're looking at two bottoms or two tops next to each other, this is where you can see or spot a divergence in the normal stochastic RSI, and sometimes they don't show on the normal RSI, not stochastic, because the stochastic is a bit more sensitive, or is faster and more sensitive. But the problem with the normal stochastic RSI is that it doesn't show you the magnitudes of the strength of these waves. It shows you a simple cyclic move up then down. So sometimes you can have something that appears to be a wave while it's not really the same strength of a wave of another wave. So for example here you had this being overbought while we were just moving sideways, and we were just making these small peaks, and there was little to get from that. Usually how I used to use the normal stochastic RSI was simply, when you keep backtesting it, you know for sure that it can't stay overbought for long. So it was just an indication for me when to exit a long and when to enter a long, and vice versa, but not or even when to, it's like a secondary confirmation for entries and exits. So for example, when I see the normal stochastic RSI being overbought for a long time, I usually know a drop is incoming, because I know from experience and from backtesting that we don't stay overbought for longer than, for example, on the daily, if you backtest, you'll see this was like 18 days. This was probably a bit longer, but still we had a small drop. Even in the previous tops, you'll always see that they are somehow a bit equal in the duration they stay up, or you can say there is like a maximum amount of days it can stay overbought from its history. So what I usually did back then before the MTF is I just looked at these and backtested them, and then I just used it as an indicator to know, okay, we've been overbought for a long time now, this has to come down sooner or later. Or for example, if I was looking for a long, I just never longed there. If I'm scalping on lower time frames, I just longed when we hit bottom and stayed there for some time, and then I added other technical analysis with it and used it as such. So this is the normal stochastic RSI, but as I said, it doesn't show you the magnitude of the different waves. So what led me to creating the MTF was simply that I was observing, and then I saw that when you look at different time frames, okay, you see that these waves have subwaves within them. So if, for example, if we take this as a reference here, where it was oversold, then it went to being overbought, and then it corrected and became oversold again. And let's just call this one wave up and one wave down, and then let's just zoom in. Maybe use the replay to go back in time. So when you zoom in here at the daily, this is just one move up and one move down, not much happening otherwise. When you start zooming in on the 12-hour, for example, you see several other waves like this, up, down, up, down, up, down, etc., etc., etc. So I was very curious to see how, even for example on the 4-hour, you see more waves. So I was very curious to see what happens when we put these different time frames on top of each other. And then when I did this, I marked, for example, here, let's just mark the overbought areas, and then see what happens in on the larger time frames. Okay, so let's just mark the overbought in red on the 4-hour, and then let's just go to the daily and see what happens on those overbought areas. Okay, when you go to the daily, what you see is at the areas when we are overbought, even if you go back and forth, this is where we make our biggest moves. Okay, so here, for example, this candle, the one before it, the one after it, this is a large move. Here the same large move. Here was probably a transitional move or whatever. Here was a large move. So when I then made this MTF Stochastic RSI Indicator, if you look at it, let's just load it now. Okay, what you see here is very simple. You see 3 time frames. You see this on one time frame where the green one is the slowest one, and the blue one is the normal one, and the gray one is the quicker one or the faster one. What you see here, for example, is one wave up, one wave down on the green one, and then you see the sub waves and the substructures within. So what happened here, how I read this is we were oversold on several time frames here. So this means if you go at this vertical line here and you go to the 12-hour, you're gonna see we're oversold on the normal stochastic, and then if you go for the 4-hour, maybe we're oversold as well. Probably here probably, because when you use lower time frames you need to consider more candles. So this is a point, and even when you go to the 3-day you might find it oversold as well. See here, which is a bigger time frame. So this is a point where you had several time frames being oversold together. This is usually when it's the weakest, or when it's being when it's having the most sell pressure. When it's having the most sell pressure, this is a point which usually indicates that a bounce is incoming. Sometimes it's a reversal, and sometimes it's just a dead cat bounce, or just a weak bounce, but it's simply a point where you have this being oversold and having a huge sell pressure on several time frames. So it's definitely a better place to enter, if regardless of technical analysis, put it aside now, it's definitely a better place to enter than when it's being oversold on all time frames. So if you look at the red highlights where it's being oversold and several time frames, these are usually either tops or short-term or local tops. Like here, for example, this would have been tricky because the green one kept rising afterwards, but at the end, even if they are not they don't have a highlight, this one, for example, here should be considered a red highlight because it has them all at their highest. So this is a top, but it's just a setting that doesn't allow for some to show up. So as I said, this could have been an entry. Okay, the second entry I would be looking for is when this is starting, the green one is the one from the larger time frame, it's getting overbought, and then you see the lowest. Think about it this way: when do you want to buy, or when do you want to FOMO while having the safest setting? Okay, let me just rephrase it. When, as an experienced trader, would you want to FOMO? You would want to FOMO when something is being overbought, like for example one of these, the normal RSI being overbought, but on short time frames you have a big dip, and you have a dip for example that is showing you divergences, and where you're having technical analysis confirmations that it's just a dip. So what I'm seeing is that the MTF is kind of doing this work for you sometimes, simply when you have and when you truly understand how to read it, because it's a bit complicated with all the curves. But how I read it is simply that the green one, which is the largest time frame, is getting overbought. We're getting in a bull trend or a bull run for this part, and then in the sub frames we have the sub waves, we have this gray one forming a dip. Okay, and it's moving down much faster than the blue one, which is usually a weakness or a fake out downwards. Okay, so it's usually this is an indication that this is just a dip and it will reverse. Sometimes when this stays down it manages to pull blue, but this is not what is more frequent. What is more frequent is when you see this forming a distance, even here before the confirmation, usually it indicates that it's gonna reverse. Whether it's gonna reverse here or there, or when it's at the bottom, usually this is what happens. So if we even scroll back a bit, you find every time, this is for example one time that it pulled it. Okay, this doesn't happen often. These are all V bottoms, V bottom, V bottom. These were both together, so they don't really count. These are V tops. Okay, and it's important to understand, because this was discussed earlier today, these V bottoms are stronger when the green one is on the upper half. Okay, because you have to understand if we are trying to picture several time frames together, understand that the larger time frames have higher weight than the smaller time frames, so they act like a magnet. If you have a coin that is overbought on a larger time frame, then the smaller time frames are going to be pulled up much more likely than they're gonna be pulled down until it reverses. So we're talking about in the middle of it, they're gonna be pulled up until it reverses, okay? And even when it reverses, it keeps giving you this signal, like it's going down and then bouncing a bit up, but not much, and then down, and here the same. So it does it in a way that usually is a bit readable. So when you think that this is the magnet pulling upwards, the green one, and then you had the both being overbought here, and then the next thing is the dip, okay? So here you have your dip, okay, and you could have simply entered this one with technical analysis, of course, simply to give you an understanding of where you're gonna be placing your stop loss, and then you could have simply taken this trade till the top, okay? Where I would exit is either here or there, or even there, when you see this small bounce and the green one is pulling downwards, okay? So I would have either exited here and get deceived somehow here, and still this would have been profit, or there, or there. But where, for example, would I short this? I would never short red, okay? I would only short a divergence. So one divergence is the divergence of blue and gray getting lower, despite the green one not getting lower. So this would have been a shorting spot. A better shorting spot would have been this one. So it's either this one or this one, okay? So again, picture these three stochastic RSIs. The green one is the slowest one, the blue one is the normal one, and the gray one is the faster one. And try to understand that usually when you have a red highlight or they're all pulling upwards, you will have the biggest moves upwards, but you will never be able to catch them and enter while they are happening, because they can simply be the top as well. Like for example here, this was a bit fast, sorry. Here this was a bit fast, so you couldn't have entered it. So never think, okay, this red one was extending in time and I could have simply entered there and then use this, because it would be very risky. Unless you're looking at lower time frames and you're managing it. Let's just say we're one of those oversold ones, okay? So I hope this helps out a bit, okay? Again guys, the green one is not necessarily an entry point. It's simply where they're all being oversold. Sometimes you see this causing a very, very large candle downwards. So when you enter on this one, sometimes it can still go down before it bounces, okay? So I usually use this with technical analysis. I'm more confident when I see the second green one. So let us just check XRP, for example. So for example here, this is the 4 hour, and then we had one green highlight here. Usually what I would do is I would be interested in the second one more than in the first one, or even in the third one more than the second and first one. Interested meaning I would be interested in longing it, but I would only do so with other technical analysis confirming it, okay? Here for example you have the 4 hour having this distance between the gray and the blue, so there's a possibility of this just making like that and then probably making a lower low or the same low, and then we are gonna have this one topping off, and then you're gonna get another green highlight, and this for example could be a good entry for a quick scalp. But again, guys, you need to keep zooming in and out to paint a proper narrative of it. Okay, if you look at the daily, for example, again, you had this being oversold there, and then it went to being overbought. Look at how the green one went up, and then you had the blue and the gray one stay up for a bit, and then they needed to relief. You had this V bottom, okay, and you could have simply entered along here anywhere with a stop loss below the lows based on technical analysis, and then you would have ridden this one for 70% easy. Okay, here for example, this is starting to be different from the first one, which indicates that the correction might take a bit longer, and this only works again for longs when the green one is being overbought, because if you look there, when we were in a correction, the green one was being oversold for a very long time, and then when the green one is oversold for a long time, you usually look for shorts on these fake outs, like here for example. This one is a V-top. You could have simply shorted this one for a nice 40% short in spot, and even those ones, this one. So you need to start with the green one. Is the green one oversold or overbought, or in the middle? When it's in the middle, there's very little you can read unless you have a really good picture from your TA in general and you're just reinforcing it with it. And then when it's overbought, you can buy the dips. It's as simple as that. Buy the dips when it's overbought, and at the beginning or in the middle, but not at the end, because when you look, for example, let us just check this Matic. I can't really find it now, but what I want to say is this can simply, oh, I remember, it was I think it was TLM, no, it was one of the, yeah, here. So for example, SLP, you see on the daily you have several highlights and small V dips within them. Never assume or never enter after several red highlights, because then the probability of this reversing gets bigger and bigger. Okay, so to wrap this up, when it's overbought, I look for dips. When it's oversold, I look for shorts with the fake outs, the fake out tops. Okay, and again, you need to always understand the idea of this having 3 time frames and the weight of them and where it's gonna pull it. Okay, and how much, look at how much effort this blue and gray one took here to lift the green one. It takes time because it's a formula taking an amount of time into consideration, and then to sum up, it takes more time or more strength, and therefore these fake outs are very useful. So I hope this helped out a bit. I'm gonna keep posting more and more, and also I really value your feedback because they help making these videos. So well, have a nice day everyone, and thank you.